Every person living in the USA eventually wonders, what kind of retirement can you expect in the United States? How to accumulate it quickly? And what options exist? In this video, we will discuss these questions, as well as I will show advantages and disadvantages of different retirement accumulation systems. The most basic retirement in the USA is Social Security. The IRS, Internal Revenue Service, collects a special tax called Social Security tax from wages or self-employment tax from self-employment earnings to create a government Social Security fund. How does it work? A person who has worked for at least 10 years can collect Social Security. This means that a minimum of 10 years of work is required. Every year, 4 credits or points are issued. Each point has its own amount that needs to be reported to the IRS. This earnings amount increases every year in line with inflation. In 2023, the amount of one credit was $1,640. Therefore, a minimum of $6,560 needed to be earned in a year to earn all 4 credits. Unfortunately, more than 4 credits cannot be earned in 1 year. To be eligible for the Social Security retirement, a minimum of 40 credits or 10 years must be accumulated. So, when you file your tax return, it is important to check if you have earned 4 credits, $6,560 in 2023. This can be income from work, wage income, or self-employment income. For calculating Social Security pension, the highest wages for the last 35 years or 35 highest wages over the course of a lifetime are taken into account, and the pension ratio is calculated. The age at which retirement begins is of great importance. The earliest age is 62 years, but in this case, pension payments are reduced by 25%. The optimal age is 65 years. If a person chooses to retire slightly later at 70 years old, payments are maximized. People often make mistakes by not accumulating enough points. I often see very few people consider reporting their side gigs, cash income, or tips. I know not many of you want to pay extra taxes, but in most cases, people take deductions and don't have to pay taxes. And why not start funding your own Social Security account from day one? I encourage you to start looking into your tax return and making sure that you or your spouse have income reported to Social Security every single year. Remember 4 points. I recommend keeping in mind this threshold of $6,560, taking into account annual changes in the inflation amount. It is also important to pay attention to each family member for the purpose of Social Security. It often happens that only one person works while the other helps with children or household tasks. This means that Social Security contributions go only to one spouse's Social Security account. I am sure that every person, even if not employed in a specific position, has some kind of side job. For example, looking after children, cleaning up, going to the store to buy something. So in the modern gig economy world, I'm sure everyone has some sort of additional job. I recommend taking the side job into account, even if it's paid in cash. We often help relatives in business, cleaning up home offices, going to the post office, making certain calls, conducting research online for business. Thus, all this work can be paid for. This allows us to kill 2 birds with 1 stone, as we say. First, those who pay for this work receive a deduction because any amount we pay to someone for certain work is deductible. Secondly, the second person who declares this money accumulates retirement credits. Also, when we ask parents, close relatives, or neighbors to look after children instead of sending them to daycare, camp, or after-school programs, we can use this opportunity not only to save on childcare costs, but also to receive a tax deduction for services provided by relatives or friends. And our loved ones can declare this income and earn points for their Social Security. Oftentimes, I observe a situation where we don't have enough points when we retire, and we have to work or wait for more time to start getting Social Security. This applies to all family members, including grandparents, parents, aunts, uncles, and so on. If you need a consultation in your individual situation on retirement accumulation, sign up for an online consultation with me, link in the description. Social Security is a state-based program not designed for people to rely solely on it on retirement. The program is designed to supplement private pension savings. Most Americans have their own private retirement fund, and if a person works for a company, the company usually provides a 401k plan. The amount a person saves in this retirement fund is deducted from their own salary, and the contributions are made tax-free, meaning that they're deducted from the salary before tax. For example, if the salary is $50,000 a year, 401k contribution is $5,000 per year. This means that the taxable base is reduced to $45,000, ultimately saving us taxes. Many people strive to maximize their retirement contributions to minimize their tax obligations. Often, employers also make additional contributions to the pension fund for their employees. Each employer dictates their own terms, such as percentage of match, vesting period, etc. I always recommend finding out if there is any company match, and most importantly, what is the maximum amount of match in your employer provided 401k plan. Usually it is 2%, 3%, 4%, or 5%. I even encountered situations where it was 10 or 13%. If the company offers you a match option and we reject it, we're rejecting the money. For example, suppose the company offers a 401k plan and you will be contributing a certain percentage of your salary to it. And your company says, if 5% is contributed, for example, we will add another 3 or 5% to your pension account. Each company dictates its own conditions. For example, with a salary of $5,000, you contribute 5%, which is $2,500. If your company makes a 5% match, another $2,500 is added to your fund, and you already have $5,000 in your retirement account. There are often situations where newly hired employees do not understand retirement savings and how it works. HR in companies does not always explain in detail how it works. And even if they explain, it seems to be complicated, and people are very scared to give away their part of their salary somewhere. They really have no understanding where they're putting it to. It seems easier to just keep their money in their own savings accounts. I will tell you more. As a college graduate, when I was offered a 401k plan, I was hesitant to contribute and was very embarrassed to ask more questions about it. Why? I graduated from college with an accounting degree, and they don't teach it in colleges, all of these aspects. For people, this can be a new and non-obvious fact, and they often worry that money will disappear somewhere. For example, what happens when they leave that particular employer? However, it is important to remember that the retirement plan funds is a well-organized and regulated system, and contributed money cannot just disappear. For instance, when you change jobs, there is a practice of rollovers, where all funds are transferred from one account to another, ensuring their storage in one place. Or simply, you can cash out your money, and that is called taxable distribution. Be mindful, in this case, you will have to pay taxes from the distribution. If the company does not provide a 401k plan or any other retirement plan, there are always alternative plans such as traditional IRA, Roth IRA, and SEP IRAs. Traditional IRA provide us with tax deductions for investments. On the sum that we invest in the fund, we receive a reduction in the tax base. Unfortunately, when withdrawing pensions, taxes will have to be paid. This applies to both cases, when we retire and when we withdraw early. In case of early withdrawal, a 10% penalty applies. However, there are exceptions to avoid this penalty: buying a home, education, medical expenses, and a job loss. In any case, taxes will have to be paid at the amount we withdraw from the pension fund. The question is whether to pay taxes now or postpone them for later. There is a Roth IRA option. In this case, there are no tax deductions for us now, but capital withdrawals and capital gains are not taxed in this case. This can be a key factor for those who want to use a Roth IRA option. Many of my clients differentiate their investments, investing part of their funds in a traditional IRAs to minimize taxes now, and the second part investing into the Roth IRAs, which are very advantageous investment accounts as they accumulate tax-free. It is important to understand that these accounts are similar to bank accounts where you keep your money. The only difference is that they are not as readily available money sitting in the savings account. However, you can let this money grow and accumulate over time. I highly recommend investing amounts sitting in your retirement account so that it's not just sitting there and losing value due to inflation, but actually grows over time. The next option for retirement account is SEP IRA, designed for self-employed or business owners. With SEP IRA, contribution limits are much higher than traditional IRA. In 2023, you can contribute up to $66,000 and compared to a traditional IRA, where limits are $6,500 if you're under 50 and $7,500 if you're over 50. So let's summarize. To quickly accumulate a retirement in the USA, first, file your tax return every year and report the income to Social Security. Do not forget about the 4 points. Second, try to invest in private retirement funds. If there is an employer, take a 401k plan. If there is no employer or the employer does not provide retirement plans, take a SEP IRA, traditional IRA, or Roth IRA. In fact, how to open them? Come to the bank and ask to open the account you need. At the bank or any other financial institution, they always have access to open these accounts. Besides the options to reduce taxes when saving for retirement in the USA, there are other possibilities to legally avoid paying them. Watch the next video on how you can minimize your taxes.